Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today we're going to discuss the S&P 500 index. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Kelly. Well, I have the chart of the S&P 500 index, which is our stock that we're going to talk about for our option strategy overall. But if I look at this chart, we see all the way back in July, that's when we crossed over the 200-day moving average. And basically, the S&P 500 index has had their foot on the gas pedal ever since then. So today we set a new high in the SPX. And if we look at where the 200-day moving average is relative to the index, we're about 545 points above that. That's right around 13%. So it's safe to say, and that's usually the case a lot of times when you're setting new highs in the marketplace day in and day out, that the markets are getting a little overextended. So what do you see in the markets going out this week?
Yeah, Brian. Well, you're right. That's the best way to explain the markets these days. Overextended and honestly pretty quiet. Stocks are pretty flat today. Thinking about what we're seeing at the moment. Mostly on news that the CDC and FDA are recommending that the U.S. stop administering Johnson and Johnson vaccines just for the moment. Based on the news, it is because of a few cases of blood clots in patients who received the vaccine. But people are worried this could be a big blow to the vaccine rollout. And the quick vaccine rollout has been one of the reasons why stocks have done so well lately and why we feel so optimistic about the economy. I mean, we're no epidemiologists over here, so I have no idea how significant or long this pause could actually be. Although I'm reading reports that say it won't harm supply too much and the pause could only be for a few days. So that's good news. But it's a story we're watching because vaccines are key at this point in the economic recovery. So that's the big headline today. Another interesting headline that I heard a lot of squawking about was the CPI report on consumer inflation. Month over month, headline CPI rose the most since 2012, which is not a great development if you're in the inflation scare camp. But, honestly, it doesn't seem to be affecting markets that much today. The 10-year yield, which tends to move higher when more inflation is expected, is actually down on the day, which is pretty contradictory to what we saw in that consumer report. And, honestly, I'm kind of shrugging this report off a little bit too. Why? Well, a few reasons I'm thinking about. First of all, this was kind of expected. The market had its little inflation tantrum back in February or March. So it's gotten a little bit of the inflation shock out of the system so far. Also, the reading wasn't unusually high when you dig into the details. So we over here at Ally Invest like to look at core CPI instead of headline CPI because core CPI excludes food and gas prices, which are usually a little more volatile. But it's not a blowout number considering that's about the rise in inflation we saw last summer. So all in all, this isn't a report that worries us. Inflation while rising is still relatively contained, especially when you put it up against big consumer confidence and services activity reports in March. I mean, I hate to call it this, but this seems like a Goldilocks situation for the market. Not too hot, not too cold, which is exactly where investors want it to be. And it's one that keeps the Fed engaged and it keeps rates low. So that's about what we're watching today, Brian. A little more excitement than usual, but stocks are really taking it in stride. So I want to hear about what you're seeing in VIX land. Tell me about that.
All right. So I have a chart of the VIX index up, and I also have my VIX watch list. And in the chart, we always highlighted ever since we've had the downturn below the 20% level, all the way over here in the right-hand corner, we see that the VIX is staying below 20, and it's basically started a new norm, if you will, as far as what is expected in volatility in the S&P 500 index options. So we see the VIX down below 17 at this point in time. And I'm going to highlight it here on my watch list. We see it at 1687. Now, today's stock, as we mentioned, is the SPX, or I should say the index that we're going to do an option strategy on or discuss is the S&P 500 index. And so if we look at the volatilities going out in time, we're going to be talking about a May expiration. We see the May expiration is trading at 2051, but I find it interesting that if we go all the way out to September, we have that futures contract that follows the VIX index is trading at 2390. So that's below 25%. Now, what has been the case, well, the VIX was trading above 20 as we saw a lot of the futures contracts have problems breaking through the 25 level. So in general, we're seeing less nervousness in the near term and a little less nervousness going further out in time in the VIX futures contracts. And I personally think that the more the long terms actually decline and come towards the actual index, or the terminology would be the spot, overall, that's a good sign for the marketplace. Now, it's just one data point, but as far as the VIX is concerned, as far as implied volatility on the option contracts, it's a data point that's worth tracking. All right. So with that said, if I go and I look at the S&P 500 index right now, we're at 4,132, up 46 cents. I'm sorry, 36, up $4.36 on the day. So today's stock is the S&P 500 index. What do you see in the rest of the marketplace, Callie, going forward?
Yeah, Brian. Well, can I just say I am so excited to talk the SPX because it's big picture talk, and big picture talk is my jam. So I'm really pumped. And in case you missed it, Lindsay released her Q2 outlook on Friday, which you should definitely go check out. It's very meaty, has a lot of really good insights in it, and it's on Ally's Community Hub. So I'll be talking a little bit about that and why our perspective of markets has changed, from a macro perspective. So overall, in this outlook, we are feeling a little cautiously optimistic. I know Wall Street really throws that phrase around a lot, but it's honestly the best way to sum up how we feel about the stock market heading into Q2. Why? Well, I think we're entering a new phase of the bull market. Up until now, the market has been fueled by low expectations and high growth. It's been the better than expected market. Economic data has blown estimates out of the water, and actual earnings growth has beaten estimated earnings growth by nearly 10 percentage points over the last 3 quarters. That's a huge beat. I can't emphasize that enough. And that's all great news. But, now expectations are high, which is also good news, but it kind of changes the game a little bit. We're all saying growth could boom this summer, and Q1 earnings season, which kicks off tomorrow, by the way, something to watch. In Q1 earnings season, analysts are expecting S&P 500 earnings to grow 16% year over year. Again, that's great news. I'm not complaining, but it could be a tough switch for investors to process. And a higher bar could lead to higher disappointment too. Plus we're seeing investors start to look for reasons to be concerned about stocks. We're not seeing, and this could be a double-edged sword, but we're not seeing as much positive sentiment out there. We think that there's a lot of talk about worries out there, like higher inflation, for example, like I talked about a minute ago, and the Fed raising rates, a corporate tax hike. All of these events are low risk in our view, but that doesn't mean investors won't worry about them and maybe change their positions based on this worry. And I'll add that historically, most bear markets have slowed down in year two. Not, some substantially, some not. But I think 8 out of 9 bull markets since 1950 have posted lower gains in year two than year one. And on top of all of that, the good news is society is returning back to normal. Vaccines, despite the J&J news, are still being rolled out. And, that means that people could actually venture outside of their houses this summer, which is, again, great news for life. I'm looking forward to it. But it could lead to lower volumes in the stock market. And that in itself could lead to a wandering market because there's less impetus, less buying power to go higher. So, to sum it all up, I know I gave you a lot of reasons, but we think it could be tough for the market to climb noticeably higher, excuse me, from these levels. But at the same time, we think there's enough buying interest to ensure that we don't see any big pullbacks either. Who knows? A 5 to 10% pullback, or maybe a little more, honestly wouldn't surprise me. But boring markets wouldn't surprise me either. And hey, it could be a nice break to get, a boring market here and there, especially after all the crazy swings we've seen over the past year. So, in total, I mean, we're expecting, flat markets that lose a little bit of momentum through the summer, just over the next few months. And we're still positive on stocks, very optimistic on stocks. We just think the markets need a breather here. So, Brian, that's what we're seeing. And I want to know how you trade these quiet markets on SPX options. But before I pass it to you, I'll remind all our viewers to drop your questions in the chat because Brian and I will be answering your questions at the end of the show. Give us some good ones. We need a challenge. All right, Brian, show me what you're seeing in SPX options.
All right, thank you, Kelly. We're going to look at an iron condor today, and if my memory serves me, I think this is the first time we're going to actually do an iron condor inside the stock play of the day. So we're going to start by looking at an iron condor. What is it? We have the Ally Invest options playbook up right now, and you see that an iron condor is basically two short spreads. We're going to be selling a short call spread, and we're going to be selling a short put spread. Now, the thing is, we're going to be doing them all at the exact same time. So it's a four-legged trade, which sounds fairly advanced, but it's pretty straightforward. If you're used to doing short spreads, short put spreads, short call spreads, this is the next level. So this basically means that we're looking at more of a neutral market going forward. We're going to give ourselves a good buffer, and that's mainly because the VIX is still high. As I mentioned, the index is right around 17% right now, which is still fairly elevated relative to before the pandemic. And so we're getting a good amount of premium on these option contracts overall. So where does the risk come from the iron condor? Selling strike C, which strike C is going to be a call option. We're going to be selling strike B. Those are the two option contracts that create the risk. We'll then be buying strike D and buying strike A. Those are our protections. Those are our legs that are going to stop the pain if the market goes hard against us in either direction. Now, the one thing that's really nice about an iron condor overall is that the market can only go one way, right? The market can stay where it's at, the market can go up, the market can go down. And if the market goes up, well, then your short call spread is going to be in pain, but your short put spread is going to be doing well. So no matter what, on one of these trades, you should be successful overall. But the key here is that we're going to be quite a bit out of the money. So because of that, we're going to be bringing in two small premiums on our 5-point wide spread. So let's look at the Ally Invest option chains. And we see the SPX at 4,132.50, up $4.50, about 0.1% today. And there's many different expirations to choose from in the SPX. So I'm going to highlight the expirations overall. There are more expirations in the S&P 500 index than any other index out there that I know of that trades on an exchange overall. So we're going to look at the May contracts and also, the May 3rd contract and the May 28th contract. And the reason why is if I'm going to do iron condors specifically on indexes, and a lot of people like to do them on indexes because of the risk of a gap open or a gap down, a gap up or a gap down on the open is a lot lower when you're dealing with an index than an individual stock. So iron condors are popular in indexes in general. Either you can do it in the S&P 500 index, like we're going to talk about today. SPY is also a very popular underlying. But as usual, whenever we talk about these strategies, they're not meant to be a recommendation. We're just trying to learn here on the stock play of the day. So we're going to look at a 45-day trade, and I'm going to explain a little bit as we go along why I'm going out so far in time. And our goal here is after 20, 25 days, we're going to look to close it. We're not looking to ride this position all the way to expiration. So first of all, let's set up the trade. We're going to look at the May 28th expiration date. So I'm going to have to scroll down. There's a lot of strikes in the S&P 500 index. And we get all the way down to the May. So we see that that's 45 days out. On the put side, we're going to go about 193 points out of the money. Now, that's based off of where the market was at before I started the stock play of the day. But with that said, we're going to be about 193 points out of the money. That means that we're going to be selling the 39.35 strike put, and we're going to be buying the 39.30 strike put. That's going to be our protection. Now we're going to go to the exact opposite side of the chain. We're going to go about equidistance out of the money. It's going to be fairly close. And we're going to be selling the 35.25 strike put and buying, the 43.25 strike put and buying the 43.30 strike put. Okay, we're going to bring in a decent credit only because we're doing two of these spreads. And I'm going to pay attention to the delta over here. This column heading is the delta. If I look at that, they're saying there's a 15% chance of the underlying finishing 1 cent in the money. That's basically the definition of delta, the non-textbook definition. And we're going to be a little bit different on the put side. I'm going to scroll back up and look at that number. And we're going to see that that delta down here is right around 22%. Now, those are in either direction. Now you combine them both and you have a little bit higher probability of at least losing or one of the spreads finishing at least 1 cent in the money as far as that option contract is concerned. So I always like to draw that attention because we still have fairly high probability, and we increase our probability by the fact that we're going to be doing two spreads instead of one. But with that said, that means we bring in two credits instead of one. So I'm going to scroll all the way down to the option strategy workbench. Bear with me here. Like I said, a lot of strikes. And we see that we're going 5 points wide, and we're going to bring in a $1.40 credit. So if we look at the $1.40, that's the maximum we can make on the trade. Now, the market can only go in one direction. So the maximum that we could lose on the trade, or the maximum this could trade for, would be $5. So if you take 5 minus 140, you're going to end up with $3.60. So that's your maximum risk on this trade overall. And that would only occur if the market at expiration finished either below the 39.30 strike or above the 43.30 strike. Okay, that's where our max loss would occur. Now, this is a cash settled index, and it's part of the reason why people like condors in indexes in general, especially cash settled ones, because all that ever happens if you were to be down on this trade is cash would change hands. You don't have to worry about trading all the stocks in the S&P 500 index, all these little headaches that are involved with exercise and assignment on actual individual stock options. In the indexes, all they do is determine how much cash goes from one person to the other person, and that's it. Pretty straightforward. Now, I left that May 20th expiration up. The May, which one are we looking at right now? We have the May 28th. So if we look at the May 3rd expiration, which is 20 days away, I am going to set up the same iron condor. And the reason why is I want to show you that I like to go out further in time on iron condors because it allows me to adjust the positions if they go against me. So if I have some time left, I can do something about it. If I do a 1 week iron condor and it goes against me, there's not much I can do besides either close it out and move on or just see where it lands at expiration. So on shorter term iron condors, it's more of a all or nothing type trade. Longer term, you can basically do something. Now, if you're correct on your forecast, question is how much, what I want a realistic expectation as to what my iron condor may trade for as expiration approaches. Okay, so bear with me here. I'm going to go down and we're going to clear out this trade. And then we're going to look at the iron condor in the shorter expiration with only 20 days remaining, implying that 25 days have gone away. And if we do that, remember, this was trading for 140. That was basically our paper trade for the day. If we go in here and we look at the Iron Condor with 20 days remaining, means we're going to buy this one, we're going to sell that one. I apologize for all the scrolling. Like I said, the chains are huge. Then we're going to go all the way down to the 4,325 strike. Let's sell that one. And we're going to buy this one. Okay, so if I look at the strategy now, this gives me a sign as to what, if everything worked out good in the next 25 days, what could I close out this position and potentially capture? And now we're looking at the workbench once again, and we see that that's trading for about 58 cents. So what is this telling me? If I put this trade on and I'm able to get this done at the midpoint of $1.40, 25 days goes away, the stock is basically where it's at. Implied volatilities are right about where they're at. Well, I would expect to make about 90 cents on this trade, a little less than 90 cents overall. Why? Because I'm seeing when we first put it on, it's trading for $1.40. Now it would be trading for about 58 cents. I would buy to close that, and that would be a debit to my account, and that would be the maximum I could make. So I like having basically a 25 day outlook on my Iron Condor, go out further in time with the expectations that I'm going to close it early, especially if I'm right on my forecast. Then that also opens things up that if I needed to adjust one side, roll it down, roll it out, roll it somewhere, I can do that in the Iron Condor, specifically in the S&P 500 index, when we have the VIX index still trading fairly high up around that 17% level. All right, a little bit long-winded, so I'm sure we're going to have quite a few questions overall, Callie. So I'll pass it back to you to kick off the question and answer session.
Yeah, definitely, Brian. I see a few good questions in the chat. By the way, Iron Condor is my favorite name for an options trade. It exceeds Fig Leaf for me. So really excited we got to conquer it for the first time ever on Stock Play of the Day today. All right, so I see some good questions from Wayne. So one question from Wayne, and this is a really good question. Hi, Wayne, good to see you. So Wayne asks, can you be put the SPX and have to buy the stock? And follow-up question is, and how do we know when indexes are cash settled? Does it show on the platform? So walk us through the mechanics of trading options on indexes, Brian, and how exactly cash settlement works.
All right, Wayne, can we be put the SPX and have to buy the stock? Okay, and that is a big reason why I actually chose the SPX over the SPY. Now, obviously, they're a different marketplace. The SPX is a little bit wider. It's very liquid, though, usually can trade somewhere between the bid and ask. But the fact that it's a cash settled index just makes things very simple, very straightforward in that if the market did go against you and ended up somewhere in between your short strike and your long strike, well, you don't have anything to worry about because you can't be put the S&P 500 index. You can't be forced to buy all the stocks in the S&P 500 index. And that's why it's referred to as cash settled. They look at the value of the index, they look at where the strike price is, and they basically either put cash in your account or take cash out of your account. With that said, in the S&P 500 index and an Iron Condor, one thing that is nice is even though you have 2 5-point spreads here, you're only going to be required to put up one margin requirement for that spread. Basically, the most you could lose is 5 points because the markets can only go in one direction. So you don't have to put up any more capital, but you get to bring in 2 credits. And in the S&P 500 index, if you just let it ride overall, you don't have to worry as much about it because it is settled in cash, and that's straightforward. All right.
All right, good explanation, Brian. I believe Wayne has one more question, Brian, and I'm going to ask you to dig deep. Think about last week's episode with Microsoft, which, by the way, self-promotion, that was a very good trade. So Wayne asks, hey, Callie. Hey, Wayne. He says, Brian, question for you. Last week on the Microsoft call spread, you looked at the cost of the $240 strike put premium to show us how much we were paying in time value. Can you run us through how that math works again?
Okay. All right. So what Wayne is referring to, and I don't think I'm going to necessarily just bring up the Microsoft chain, but if you're trying to figure out time premium and you're looking at an in the money call option that has intrinsic value, you can do the math to find how much time premium you have. You take where the underlying is trading at, subtract out the strike price, you get that intrinsic value, and then you subtract that from the actual option premium, and that will give you the amount of time value that's in that option contract. That is a fairly simple math, but it's a little bit of a pain to go through all that to try to just figure out time value. So there's a quick and dirty solution. It's not always going to give you the perfect number, but all you do is if your option contract is in the money, you look at what the put is trading for on the same strike line. So whatever value the put is trading for would be all time value. Why? Because it's an out of the money option, because the call option is in the money. And usually the put time value will be the approximate time value of the in the money call on that same strike line and expiration, obviously. So how would I go about figuring how much time premium is now in that Microsoft spread that we talked about last week? All I would have to do, both option, no, not both of them are in the money quite yet, if I recall. But basically, you just look at the in the money option contract, and you just look at the put, and that will tell you approximately the amount of time value that you have in your long call option overall.
All right, good explanation, Brian. Okay, 30-second speed round for you, Brian. And this is a question coming from me. So I know you explained what could happen, if stocks go down, if stocks are flat, pertaining to this trade. How do you adjust the trade if stocks rocket higher, or if we see like a 5% rally in the next month, or just a rally in general, a short term?
Right, because we're looking about, actually, I'm glad you mentioned that number, because we're going to be about 5% out of the money. A couple hundred points in the S&P 500 index is about 5% just in general. So if we did get a rocket to the upside or a rocket to the downside, a couple of things that you can do is you can let it run, kind of hope that it comes back. Sometimes there's just many things you can do with an iron condor because there's so many legs. But a simple thing to do is to actually close out. Let's say it's rocketing to the upside. So that means that our short call spread is in danger. Well, our short put spread should be doing fairly well. One of the things you can do is actually roll that up. Bring in some more credit to help offset the risk of your short call spread, and then just let your call spread ride. So stay in the same expiration, close it out, make a gain in your short put spread, and roll that strategy up. Now, if you're looking at avoiding a loss in the short call spread, well, the loss is already baked in, but you might do something as simple as just rolling up in strike on the short calls. In other words, taking a little loss on the short call spread and rolling it up at the same expiration, but further out in strikes, giving yourself a little bit more of a leeway as to where the underlying stock could land if you were correct on your forecast overall. So it's all about rolling spreads. And one of the biggest things about an iron condor, if I'm looking to do these type of trades, if I am adjusting the position, I'm usually adjusting the entire spread, either the call spread or the puts spread overall. But there's a lot of options because we're going so far out in time. But obviously, if we're correct on our forecast, then life is simple. And I'm looking to take this trade off about 20, 25 days into it.
All right. So we have some optionality. That's good. All right. So I think that's the buzzer. I think we're at time, Brian. So we'll wrap it up for questions today. Thank you, everybody, for joining us for today's Stock Play of the Day, Iron Condor edition. I'll remind everybody, too, that Brian will revisit this trade this Friday on Stock Play of the Day Overtime, which happens at 12 p.m. Eastern every Friday. It's a good way to cap out your week, and I'm sure Brian would agree with that. So, Brian, take us out.
Right. So please remember to click subscribe and ring the bell, and you'll get all of the alerts for the Stock Play of the Day. And we'll see you this Friday. Thanks for coming, everyone.